You think compounding is magical from day one. You hear people say things like, just invest consistently and your money will explode over time. But nobody talks about the brutal middle. Nobody talks about the years where your portfolio barely moves, where you sacrifice weekends, delay purchases, skip vacations, and still feel financially stuck. Nobody talks about how compounding feels completely useless until suddenly it isn't. And by the time most people finally understand this truth, they are either too late or too impatient to benefit from it. The hardest part about investing is not the math. It is surviving long enough emotionally to let the math finally matter. Most people quit before compounding becomes powerful. They stop investing, panic during crashes, or sabotage themselves right before the curve begins to bend upward. And the tragic part is, they often quit only a few years before everything would have changed. This is the story almost nobody tells honestly. In the beginning, your money barely works for you. You are doing nearly all the heavy lifting yourself. Your paycheck is carrying the entire financial future on its back. Your discipline matters more than your returns. Your sacrifices matter more than your portfolio. And that phase can last far longer than most people expect. Imagine a young man named Daniel. He was 25 years old and had just started his first real job after college. His salary was decent. Nothing extraordinary. Around $70,000 per year. Not rich, not broke, just normal. Like millions of people trying to figure out adulthood while pretending they already understand money. Daniel did what everyone told him to do. He opened a brokerage account. He started investing in index funds. He contributed around $900 every month automatically. He watched videos about wealth building. He listened to podcasts about compound interest. He believed he was setting himself up for financial freedom. At first, it felt exciting. Every contribution felt meaningful. Every paycheck deposited into investments made him feel responsible and mature. He imagined future wealth growing silently in the background while he slept. He pictured himself becoming financially free by his 40s. Then reality arrived. At the end of his first year, Daniel checked his portfolio. He had contributed around $11,000. The market had performed reasonably well. His account sat at roughly $12,000. Technically, he had made progress. But emotionally, it felt tiny. One full year of discipline for what looked like barely any difference. The excitement faded quickly. Year 2 felt even stranger. He kept contributing. He stayed disciplined. He ignored temptations. But the account still looked small. Maybe $25,000 by the end of the year. Better than before, but not life-changing. Not freedom. Not even close. Meanwhile, his friends were spending aggressively. New cars, expensive apartments, luxury vacations, and designer clothes filled their lives. They looked happier than him. They looked freer than him. Daniel sat at home watching his account crawl upward, while everyone else seemed to enjoy life. That is the psychological war nobody prepares you for. Investing often feels like punishment before it feels rewarding. You delay gratification while seeing almost no visible reward. Your future self is supposedly benefiting, but your present self feels poor. By year 3, Daniel began questioning himself. He opened his investing app less frequently because it only reminded him how slow everything felt. He had almost $40,000 invested, but emotionally, it still felt insignificant. The growth was too small to change his life. His salary still controlled everything. If an emergency happened, he needed his job. If rent increased, he needed his paycheck. If inflation rose, he felt it immediately. His portfolio was growing, but it was not powerful yet. It still felt fragile. This is where most people quietly give up. Not because they lack intelligence, not because they lack discipline, but because the emotional reward system feels broken. Human beings want visible progress. They want evidence that effort matters. Compounding does not give that early on. Compounding hides its rewards until later. Daniel almost quit multiple times. One afternoon, after another frustrating week at work, he sat at a restaurant with his friend Marcus. Marcus had spent years chasing quick money online. Crypto trades, options trading, meme stocks, and side hustles promising overnight success filled his attention. Every month, Marcus seemed obsessed with a new opportunity. Marcus laughed when Daniel mentioned index funds. "You're doing all that just to make a few $1,000s a year?" he asked. "That's way too slow. You need leverage. You need bigger returns." Daniel stayed quiet, but internally, the words hurt because part of him feared Marcus might be right. That night, Daniel stared at his portfolio again. Around $52,000 after years of discipline. It suddenly looked painfully small compared to the effort required to build it. He imagined how much faster wealth could grow if he took bigger risks. This is another dangerous phase of investing. The slow middle creates vulnerability. When progress feels invisible, people become desperate for shortcuts. And desperation is where bad financial decisions are born. For several weeks, Daniel became distracted. He watched videos about turning small accounts into millions. He researched risky investments. He fantasized about escaping the slow process completely. But something stopped him. One evening, Daniel visited his grandfather, an old quiet man named Henry, who had spent 40 years working as an electrician. Henry was not flashy. He never talked much about money. But Daniel knew one thing. Henry had retired comfortably decades earlier than most people around him. While helping Henry organize old papers in the garage, Daniel accidentally saw investment statements stacked neatly inside a box. The numbers shocked him. Henry's portfolio was worth millions. Daniel stared in disbelief. "You were rich this whole time?" he asked. Henry laughed softly. "No," he replied. "I became rich slowly." Daniel sat beside him, confused. "But how?" he asked. "How did it grow that much?" Henry leaned back in his chair and smiled. "For the first 15 years, he said, it felt like nothing was happening." That sentence changed everything. Henry explained that in the beginning, investing feels almost pointless because your contributions matter far more than your returns. Your portfolio is too small for compounding to create dramatic visible changes. You are planting seeds, not harvesting trees. But eventually, something shifts. Henry grabbed a notebook and began writing numbers. At $10,000 invested, he explained, a 10% return gives you $1,000. Helpful, but small. At $50,000, 10% gives you $5,000. Better, but still not life-changing. At $100,000, now you're earning around $10,000 annually on average. That starts feeling meaningful. Then Henry paused. But around $300,000, he said quietly, everything changes. Daniel looked confused. Henry continued writing. At $300,000, a 10% return gives you $30,000 in a single year. Suddenly, your portfolio is doing more work than your savings account. The money begins carrying itself. Daniel stared silently. For the first time, he understood why the early years felt so painful. Compounding was technically happening, but his portfolio had not reached escape velocity yet. The engine had not fully started. Henry explained something even deeper. The first phase, he said, requires the most discipline and gives the smallest emotional reward. That's why most people never reach the second phase. Daniel listened carefully. You think the goal is becoming rich, Henry continued. But the real goal early on is surviving long enough to let compounding finally matter. Those words stayed in Daniel's mind for years. From that moment forward, he stopped expecting excitement from investing. He stopped needing emotional rewards every month. He accepted that the beginning was supposed to feel slow. And strangely, that acceptance made everything easier. Daniel became consistent instead of emotional. He automated his investments completely. He stopped checking his account daily. He focused on increasing his income instead of chasing unrealistic returns. He stayed patient during crashes. He ignored financial headlines designed to create panic. Years passed quietly. At age 30, Daniel crossed $100,000 invested. For the first time, the portfolio started feeling slightly alive. Market growth began creating noticeable changes. Good years added tens of thousands of dollars. Bad years hurt, but the account recovered faster than before. Still, the process felt slower than outsiders imagined. People online constantly talked about overnight wealth, viral success stories, instant millionaires, and fast money distorted reality. Daniel realized those stories created unrealistic expectations. Real wealth rarely looks dramatic while it is being built. Most financial success happens invisibly. Nobody notices the years of consistency. Nobody celebrates boring discipline. But boring discipline is exactly what creates extraordinary outcomes later. At age 33, Daniel crossed $250,000 invested. Now the numbers became impossible to ignore. During strong market years, his portfolio grew by amounts larger than his first annual salary increase. The market sometimes added more money in a year than he personally contributed. This was the shift Henry described. The portfolio was beginning to outwork him. Daniel felt something new for the first time in his financial life. Leverage. Before, every dollar required his time, labor, and energy. Now money itself was generating more money automatically. The system was finally accelerating. Then came the most dangerous phase of all. Success created temptation. After years of sacrifice, Daniel felt he deserved rewards. He considered upgrading apartments, buying a luxury car, spending more aggressively. After all, he finally had real money. But Henry warned him about this too. The years immediately after momentum begins, Henry once said, are the most valuable years in the entire compounding curve. Daniel finally understood why. At $300,000 invested, average returns could generate roughly $30,000 annually over time. At $500,000, that became roughly $50,000. At $1 million, around $100,000 annually on average. The curve was bending upward faster every year. Interrupting compounding now would be incredibly expensive. So Daniel stayed disciplined. Not extreme. Not miserable. Just intentional. He still enjoyed life. He traveled occasionally. He bought things he genuinely valued. But he stopped confusing status spending with happiness. He realized many expensive purchases were actually emotional distractions disguised as rewards. His real reward was freedom. Freedom from financial panic. Freedom from depending entirely on a paycheck. Freedom from constant money anxiety. Then the market crashed. Suddenly headlines screamed fear everywhere. People panicked online. Friends sold investments. Financial channels predicted disaster daily. Daniel's portfolio dropped massively in value. Years earlier, this would have terrified him. But now, he remembered Henry's lessons. Crashes are not interruptions to compounding. They are part of compounding. Daniel kept investing. Every month, no matter what. While others panicked, he continued buying. That decision changed his life permanently. Because the market eventually recovered, like it historically always had. And the shares Daniel purchased during fear became some of the most profitable investments of his life. This is another truth most people misunderstand. Compounding rewards. Patience during uncomfortable periods. Not during easy periods. Anybody feels smart during bull markets. Real investors are built during uncertainty. By age 40, Daniel's portfolio crossed $1 million. But the strange part was this. The $1 million itself did not feel as life-changing as outsiders imagined. The bigger transformation happened psychologically years earlier when his portfolio first began generating meaningful momentum. That was the real breakthrough. Once compounding became visible, everything about money changed emotionally. Fear decreased, pressure decreased, financial stress weakened, choices expanded. Daniel no longer felt trapped by every paycheck because his portfolio had become a second engine quietly working beside him every day. And the truly incredible part? The majority of the growth happened in the later years, not the beginning. The first $100,000 took enormous effort. The next several hundred thousand arrived much faster. The million came faster than he ever imagined possible. This is why compounding feels deceptive early on. Human brains expect linear growth, but compounding is exponential. Tiny visible progress eventually transforms into overwhelming momentum. The beginning feels almost broken. The ending feels almost unfair. And the people who benefit most are usually not the smartest investors. They are the most patient ones. So if you feel discouraged right now, if your portfolio feels small, if progress feels invisible, understand this clearly. You are not failing. You are likely still in the invisible phase. The phase where your discipline matters more than your returns. The phase where consistency feels unrewarded. The phase where most people quit. But if you continue, if you survive long enough emotionally, eventually the math changes. Your portfolio stops feeling like a bucket slowly filling with water. It starts feeling like an engine creating momentum on its own. That threshold looks different for everyone depending on income and savings rate. But for many investors, somewhere around $300,000 is where the psychological shift becomes undeniable. That is where compounding stops whispering and finally starts speaking loudly enough for you to hear it. And once you hear it, everything changes. You stop obsessing over quick money because you finally understand real money. You stop chasing shortcuts because you realize consistency is the shortcut. You stop needing motivation because the results themselves become motivating. Most people think wealth is built through intelligence. Often, it is built through endurance. The ability to continue when nothing exciting appears to be happening. Because the greatest financial rewards usually belong to the people who stayed patient long after impatience would have felt reasonable. So if your portfolio still feels small today, do not underestimate what you are building. The early years are not wasted years. They are foundation years, the invisible years. The years where your future freedom is quietly being constructed brick by brick, while the world mistakes patience for failure. One day the curve bends. One day the numbers finally move faster. One day your portfolio grows more in a year than you once earned from working full-time. And when that day comes, you will realize something powerful. Compounding was never broken. It was simply waiting for enough time to reveal what it could really do.